Greetings, my fellow Fannie Mae and Freddie Mac warriors. So the main question right now is, what is a realistic P/E ratio of Fannie Mae and Freddie Mac? The P/E ratio is the standard where how the value of the company is evaluated, and that is how much is the price of the share divided with earnings. And basically the similar companies that are in a similar business have the similar P/E ratio. And for example, it depends, that P/E ratio depends how the company is profitable and how much it, for example, the, let's say the iron industry or the oil industry don't have the same P/E ratio as the real estate, and they don't have the same P/E ratio as financials, and all of that don't have the same P/E ratio as some digital growth company. So why? Because of the money you invest in the company and how much profit it makes and what are the expenses and how much is left over for the dividends and the other stuff. So that is how the P/E ratio is actually evaluated. For the digital company, like let's say like Facebook, it is high P/E ratio because the Facebook is just one website with several thousand employees, and they're selling they have the servers, they have everything, so they have the certain amount of the expenses to maintain the servers, to maintain the infrastructure, but they're selling the marketing space. People come and watch, and so on. So they have some expenses, they have some earnings. For steel industry, for example, they need to provide the ore, they need to take the coal, to combine it, to burn it, to create the value, to sell it, and the amount of the profit they make compared to the Facebook is much smaller, so the P/E ratio should be smaller. The bank, on the third side, the financial institution also has whole infrastructure. They have the buildings, they have the client services, they have the risk management, they have the compliance. The companies spend more on compliance than almost on anything else. So they have like a lot of expenses. The question is, how much earnings vs profit is for Fannie Mae and Freddie Mac? Is it as much as it is for steel industry, what is low P/E ratio, let's say, or oil industry that is also low P/E ratio? Or is it, for example, like for financial institutions? Or is it as for digital media and let's say like Facebook? In my opinion, Fannie Mae, Freddie Mac are in a specific position. It is not like a financial institution because it doesn't have the maintenance for buildings, it doesn't have the maintenance for the clerks, it doesn't have the all other expenses they have. They don't have so much fraud as they, for example, compared to the bank. They have even less compliance because it is like only one small company in the essence, because they're just taking the paperwork, which is almost automated. So they have much bigger margin of profit than the bank. Compared to the Facebook, in my opinion, they also have more, because the Facebook have the magnitude of the servers, and that spend electricity. They need to upgrade it, they need to add storage space, they need to save everything so they can control you later. So all of that they need to invest and keep the money flowing, and it is decreasing their profit. Compared to Fannie Mae and Freddie Mac, that is basically right now almost completely digitalized. So they take one file, take the numbers from the file, what AI can do. They took those numbers, put over here, transfer over there, have the automated system, everything, almost everything is automated. Amount of the data they store is significantly lower than Fannie Mae and Freddie Mac, than Facebook. So it is logical that they have less expenses. Less expenses, more profit, higher P/E ratio. And let's see, to take another company that I like always to take in question, it is Netflix. Netflix is the company, they say, you know, okay, it's subscription based, it is digital company, it is like growth company, and all of that is, that's why they have the P/E ratio of 40. Is it a lot? Netflix needs to pay all other companies, Fox News, they need to pay the Columbia studio, they need to pay Disney, they need to pay this and that for the copyrights they will actually broadcast to their network. So Netflix has the profit of $5 billion per year. P/E ratio is 40, something like that. How much is the P/E ratio? It is large number. So the P/E ratio of Netflix is 38.40, and net earnings is $10 billion. So let's thus compare that with the Fannie Mae and Freddie Mac. First, as I said, like Netflix has the more expenses. They have the customers which are not, they don't have monopoly. Fannie Mae and Freddie Mac has, and the cost of the operation is much higher than Fannie Mae and Freddie Mac. So basically, Fannie Mae and Freddie Mac are in much better position than Netflix. Consider the market, consider everything. Now, yeah, Netflix has $10 billion net profit and 40 P/E ratio. That brings the value of the Netflix to $400 billion, $500 billion. Let's say now Fannie Mae and Freddie Mac, they have currently, under the distress, under the bunch of the money put on a side, under the all the problems they have $30 billion combined of profit. If we take this, it is same P/E ratio, but I would like to suggest that it is higher than Netflix, because as I said, like because of that stuff that I have mentioned. 30 times 40, so $30 billion times 40 billion times $30 billion times 40 P/E ratio is 1,200. That is $1.2 trillion is the value of Fannie Mae and Freddie Mac combined. What does it mean? In the other video that I have said, if they have market capitalization of $1.2 trillion, what is realistic for the earnings they have right now, but earnings will be bigger. The value of the company is $1.2 trillion, divide with 10 billion shares. What is the price of the share? By my calculation, I divide 1200 with 10. And that is my calculation. That is how it's calculated. It is market capitalization of 1.2 trillion, divide with 10 billion shares. It is 1200 divided with 10. It is $120 per share. And that is share that costs today $10.50, 11. Is it good investment? Yes, it is. Stay well, my friends.